Good afternoon. It's our 3 p.m. again on Tuesday. So every Tuesday we bring to you a short topic, and the Saturday 3 p.m. is where we do a extensive teaching and you do a extensive learning. So this Tuesday, what we want to talk about is one of our clients came to us and he runs a pretty good business, but he have a little hard time to know how to pay himself. So he is worried about paying himself will trigger too much taxes, or paying himself not enough will trigger audit. So there's a lot of worry around it. So what we're going to do today is to lay it out all the ways that you have as a business owner. You can pay yourself this way and that, then we will cover in terms of the taxes. You see, in taxes, the taxes is either you don't need to pay because you didn't reach that level, or you delay the pay because you have a way to delay your income to the future. So at the end of the day, if you need to pay taxes, you need to pay tax. The strategy is if you delay into a lower tax bracket, so you win on that end, or you deduct it properly so you don't even pay tax at all. So let's just kind of dive into it. Before we go for the topic itself, and just briefly introduce our firm to you. This is our website, communitycpa.com. And you can come here to log into your client portal, where you're going to see all your files and your related companies with our firm. And all of our data is in there, and you literally can tap into it at any time you want it. And of course, the payroll portal is for payroll. Our onboarding with us button is unique. You don't have to talk to us. You don't have to say, oh, I want to be your client, because your action of getting in, set up your account, and start uploading your information to us, it is already a trigger for us to know that you want to be our client. Then we work with you immediately and we actually contact you. And the appointment button on the top, that's where you meet us. So say you saw me today on webinar and you want to ask more questions, then you can click that appointment button and book my time, and we will meet on Zoom. There's a Zoom conference meeting that we can do whenever I am available. So you will see my calendar online. Of course, that pay invoice button is just for you to support us so we continue on the journey to serve more of you, right? All right. Our YouTube channel is also another one very crucial for us to give knowledge to you. And you don't have to come at 3 p.m. You can come at any time. If you go to YouTube channel, you search for Community CPA channel, you will see what you see right here. So you can see that we have 6,480 some followers, and we have more than 1,200 videos in here. Like today's topic, we actually talked about it before, but there is more demand, so we want to refresh that talk and hopefully bring to your attention, and you learn the ways that you can pay yourself in your business. And quickly about our firm, and nothing really, nothing gonna stand out for you except, and we have 10 different languages we speak in the firm. So we are truly a united nation, and in action at the professional world. And I also have 2 books that are already on the internet you can purchase from Amazon. And these books are the one I published in 2019. The other one I published in 2023. So I'm doing the 3rd one, and I have the number 4 coming up. So the 3rd one is 2 p.m. and the number 4 is 6 p.m. It represents the business process. Now, no responsibility disclaimer. You know that when we exchange knowledge like that to you and with your time, and you hear us, if you are going to take any of those information to a action, just make sure you're sure about it, or you have that professional relationship, consultation relationship with us, so that you can go forward and implement it to your benefit, right? All right. So let's take a look at what we have now, ways to get paid. So there's so many ways. I want you to remember there are 9 ways to get paid. If you are a business owner, you have 9 ways to pay yourself, okay? So number 1 is salary. Number 2 is contractor payment. Number 3, K1. Number 4, 1099 dividend, okay? 1099 dividend. Then number 5, loan from your business. Number 6, reimbursement by your business to you. Number 7, company paid benefit for you, for your future. And number 8, pay back loan to company or capital draw. Means that you're going to draw your capital out tax-free, right? And the vendor payment. And pay you as you are a vendor, like you are Walmart. And you just write a check for yourself, and it's sort of like reimbursement or can be a vendor payment. Means that you may be another company that you can write check from your company to your company and to yourself. So these are 9 quick ways. So the other thing I want to mention that there's 4 regular business structure, right? You either sole proprietor, you file yourself under 1040, or you are a partnership, you file 1065 tax form, or S corporation 1120S or C corporation 1120. I didn't list 990, which is the non-for-profit organization, but these are regular small business structure. Am I right? So out of these structures, there's different ways. The 9 ways, I break that into these 4 type of structures. Let's go through that quickly. So proprietorship, right? You do that on Schedule C. And also that's including Schedule E as well. If you are doing rentals on your under your name and you file Schedule E and you are an active real estate professional, so you are also doing a business there. So whatever you have, this is the key, whatever you have left in your bank account, because you have a sole proprietorship, so this is really your personal bank account plus the business activity. So whatever you have left in that bank account, that is what you can write to yourself, because it doesn't matter and you write yourself 0 or you write yourself the balance, you already pay taxes for it. You know, these kind of structure, they don't really save taxes for you. Whatever you made is pays taxes immediately. So that's why it is important to know that if you have a sole proprietorship, your bank balance is really what you can write for yourself. You don't want to, you don't need to kind of figuring out how much is the right amount. What should I do? And am I paying more taxes? Those are irrelevant questions because you're already paying taxes for all of it. So whatever balance you have in the bank, write yourself a check, pay yourself, that it doesn't trigger taxes, doesn't trigger more taxes, right? The next one is the other ways, though you also can do a W-2 for yourself, but that really is sort of like it is unnecessary, right? Because your Schedule C, whatever left on the profit is like your W-2. You are already paying Social Security, Medicare on it, so you don't need to do a W-2. But if you want, that's fine. And 1099, same thing. And you don't need to do that because you are already paying for it. Reimbursement from the company, sure, why not, right? If you spend a bunch of money to buy supplies, but that supply is really for your business, then you want the business to reimburse you. That is non-taxable, so you can definitely do that. And the company paid benefit, sure, if you are under Schedule C, you can pay to your solo 401k, and in 2025 you can put away $23,500. In 2024 you can put away $23,000. So why not, right? These are money you take out for yourself, but no taxes for yourself, and the business can deduct their income tax. Of course, vendor payment, if you if you have a Schedule C business, but you also have another business which is not Schedule C, say S corporation, then of course Schedule C can pay to the S corporation for the services S corporation provided to the Schedule C. Makes sense, right? So this is you yourself, and you can manage all of these money back and forth and how to best utilize your tax efficiencies. And we're talking about efficiency, not talking about not paying taxes. If we made money, we pay taxes. But if you have room to make it more efficient, you don't have to pay taxes. You can let the taxes to come out in the future, like the $23,500 I was talking about for 2025. That one, if you deduct that in this year, 2025, you drew that out 20 years later, and that's the time you will pay income tax at those future years. I always say that the tax people are different from financial planners. In the financial planning world, they want you to not even drink Starbucks coffee because those $7 per cup and going to give you $1 million if you save it every day and to the future. So that is the mentality of financial planning. Tax is different. On the tax saving, tax planning side, it is immediate pleasure. It is present. It is today, because the tax is a thing that changed by the residents of the White House, right? Whoever is the president, the tax would change. You really don't have the superpower to know what happens when 20 years later. 20 years later, maybe there's no more taxes for seniors. So don't buy in any tax savings for the future, because those are all, people are assuming we are the same. We are not the same 20 years later. We're not even the same. When I was young and doing taxes the first time 28 years ago, and the tax is different than right now. And right now, the taxes are much more friendlier to the seniors. But before, it was not like that. So don't buy in the future tax saving. When you talk about tax saving, it is only today. It is only right now. It is about present pleasure. It's not about save the future. So knowing that is the philosophy, we always just talk about today's saving, tomorrow's saving. We don't even talk about the day after tomorrow. All right, let's talk about the other structure, partnership. When you are in the partnership, okay, so take money out for partners, right? Maybe you're not the only one, right? So Joe and Francis, these two characters are in my first book, Appointment with Ying at 8 a.m. I actually wrote, this is real stories, but of course I kind of used phantom names, but they're real story. So there's these two, they got paid differently. So because they have a partnership, the partnership can be structured by three major elements: the income, the expense, and the equity. So Joe and Francis, their equity is 50-50. What that means is if they sell the partnership, whatever they sold, the money they made on the selling is 50-50. But the other one is profit. When there is a profit, and Joe will get 10%, and Francis will get 90%. Because Francis is the one working the labor, Joe was the investor. But when there is a loss, Joe will get 90%. Francis will get 10%. Because Francis don't have a lot to write off. But if Joe has a loss, and he can offset some of his capital gains. So with that said, so these are the structure was flexible in the back end. And when you have a partnership, to pay yourself properly has a lot to do with that operating agreement. So I want to make sure that it's beyond what you just on the surface, how much money I'm going to write for myself. No, it is a little deeper than that. You need to set it right from very beginning. So generally speaking, there is 5 ways in the partnership people get paid: salary, guaranteed payment, capital draw, reimbursement, and K1 disbursement, K1 distribution. Okay, that's the right word to say. So these are, the guaranteed payment is worth mentioning. So if you have a partners that everything is equal, say you just did operating agreement from profit, loss to equity is all equal. And then obviously one partner works more than the other one. Then you want to reflect that either on the W-2 or on the guaranteed payment. You don't have to do W-2 at all in partnership. Not like S corporation, we need to run W-2, but partnership don't need to, you don't have to. But of course, you need to show that as a guaranteed payment, so you pay this partner properly based on the amount of work he did. Guaranteed payment, it goes to the partner's 1040. The partner would pay Social Security Medicare on that as well. So capital draw, of course, so you can draw that free when you have the basis, but once over the basis, you're capital gain, right? So with reimbursement, that's very easy to understand. If one partner spent this money for the company, of course the partnership should reimburse. The other partner also can reimburse what he spent. So with that said, it is a fair game when it comes to spending money for the partnership. Everyone can get reimbursed. And in the case where it's also in my book that if the partners doesn't have equal economical lifestyle. For example, if you have a partner who lives in $1 million mansion, but the other partner lives in the apartment, and if you have them, if you reimburse them for home office reimbursement, it would be not fair, right? The one with the mansion can have a lot bigger amount. The other one has a smaller amount who lives in the apartment. So what we recommend in that case is that the partner don't reimburse that kind of things inside of the partnership, but bring that into their 1040. In their 1040, there is another schedule to support the partners. You can deduct all your expenses for the partnership, but was not reimbursed by the partnership. Remember that? It's a supplemental income and expense sheet, so it is inside of your 1040, inside of your Schedule E. So I just want to mention that so you know where to find it. All right, and on the partnership, of course, these are additional things you can do. You can do company paid benefit, same thing, just like how you were doing on Schedule C. And you can also run 1099 payment loan from the company, which is tax-free if you do loan. But if you do loan from the company, from the partnership, you want to make sure that you have this minimum interest imposed, because it has to be look like a loan, behave like a loan, right? You can't say it is a dog, but it's a puppy running around. So you want to make sure that you follow the guidance to do those loans to the partners, or whether it's to the owners. All right, next one is the third one is S corporation. S corporation is by far is the most popular small business entity right now out there. So remember, S corporation requires payroll, and also has this thing called a reasonable payroll. The IRS understand some of those shareholders, they simply just don't want to run payroll because they don't want to pay Social Security, Medicare. Everything went through K-1 distribution. That K-1 distribution do not subject to Social Security, Medicare payment when it landed on your 1040. That's why it has become an area where a lot of tax savings was coming through. So if it was not planned properly, people could not realize they need to do W-2 but run away with the distribution. That doesn't work. You have a lot of tax court cases out there, and one of the most famous one on record is actually an Iowa-based CPA firm. The partners was paying themselves $250,000 on distribution, but their payroll is only $25,000. So IRS came around, adjusted payroll to $100,000, reduced their distribution, but that caused them to come up with a lot of Social Security, Medicare that they did not pay for themselves. So those reasonable pays are important. We want to make sure that we vet it through that process, know what you need to pay yourself on the W-2. And in one of our videos, and we do talk about how to calculate reasonable pay. So these are the ones you're not going to find anywhere else because it's coming from our experience. We have gone through audit, appeals, litigations unrelated to reasonable pay for lawyers, for other professionals. And so we knew how exactly that should be calculated. We created a reasonable pay formulas for our client. So if you have questions on that, don't hesitate. Look for our videos or just simply set up a consultation session. We will walk you through and determine that reasonable pay for you, because that is one way for you to get paid, right? So the distribution part, the K1 part, has no self-employment tax. That's why that part is a significant tax saving strategies for many businesses. So each share of stock gives the shareholder equal right to the retained earnings, to the distributed total. The distribution of the retained earning is determined by the number of shares owned by each shareholder. So in S corporation is a little different. Actually, it's a lot different than the partnership. Remember, I was talking about the partnership has 3 tiers on the operating agreement. You got a profit, a loss, and equity. But in S corporation, as a corporation, it is only one ratio determines everything. So that ratio is the shareholders. What percentage you are, 50-50, then everything about shareholders 50-50. So there's no difference between profit and loss and equity. So that is something we want you to be aware of, that there's no flexibilities like how the partnership has. All right, then of course, for S corporation, you also have other ways to pay. You can pay yourself 1099. And let's say you run yourself a payroll, and then your payroll, you are managing the company, but you're also a graphic designer. So whenever you design something, that would be a 1099 payment, because the nature of service is very different. You can also loan money from the company, which is non-taxable. You also can get a reimbursement from the company, which is non-taxable, because you spend money for the company. Now the company pay you back. That is not taxable. But company can deduct that as expense. Of course, company can pay benefit, right? Pay benefit like the $23,500 solo 401k I was talking about, you're entitled to. And you can also develop profit sharing 401k inside of your S corporation, match 25% of your gross salary at the end of the year. Put that into your retirement account and reduce that out of your S corporation income. There's many ways to reduce your income. So, the key is to have those elements all in. So for example, the maximum 401k contribution is the self-deferral, $23,500 plus 25% of your gross salary. So with that said, and you can easily get to $60,000, $70,000 a year on that saving, remember, and you don't have to pay taxes on that. The company don't pay taxes on the 25% of the gross salary. You don't pay taxes on the $23,500 you deferred over. So if your W-2 is only $50,000 a year, then your taxable income is only $26,500, because the other one went over to your 401k is not taxable, right? So, of course, you can always pay yourself back from the loan you loaned to the company. So that's tax-free as well. Of course, vendor payment. If you have other company that you own, and this company need to pay services fee to the other company, then you have a vendor payment, just like how you pay Home Depot, how you pay Walmart, right? All right, our last one is the C corporation. C corporation is a corporation where the separation between C corp, between the corporation and your personal, is most clean. So C corporation is kind of the company that President Trump has declared 6 times on bankruptcy. So obviously you know how wealthy on the personal side he is. So 6-time bankruptcy on C Corp, it didn't create any problem with him. So that tells you the separation. So that's taxes. Just like he said, he knows how to take advantage of the taxes. So this is where we always want to tell folks that if you are operating a risky business, when I say risky business, I am giving you examples of, for example, you are running a bar. That's risky business. People get drunk and things can happen. So, you don't want your personal stuff to be related to that. For President Trump, he was running gambling ground. And so that's why it's a C Corp, right? So anytime when you run things that risky, where you don't know whether financial gain is really guaranteed, then that really should be a C Corp. Inside of the C Corp, you only got 2 ways to get paid. Number 1 is you pay yourself as an employee. Number 2, you pay dividend to yourself. The company made money, you pay taxes, and then you pay dividend. This is where folks talk about double taxation, because you paid 21% on the corporation tax, then you have dividends, and when you distribute that to yourself, and it become dividend tax on your 1040, right? But I still say that folks, don't get confused with your C corporation versus what you see on the internet. A lot of those C corporations are public companies. And when public company is running their business, they have to pay dividends to their people, to their shareholders that they bought their stock online and stuff like that. So they are required to pay that dividends often to even keep the company afloat, keep the company momentum going. But when you are privately held, closely held business, it is your company. You decide on when and how to pay dividend, and you decide on how to spend your money. So if you really had $1 million dividend in your company, and I would already start looking at how to invest that. And we have so many ways we can talk about how to invest inside of C Corp. That could be a separate webinars. I don't think we really specifically talk about how to invest in the C Corp, but C Corp is the company that can do everything within themselves, just like a person, a U.S. person that conduct business in U.S. on its own. C Corporation is also a corporation that allows the foreign investors and the foreign owners in the structure. So giving that thought, it is a pretty dynamic and a pretty flexible and can have a lot of in-depth application with the C Corp. Type of dividend report on the form of 1099 DIV, that is the dividend that come out of your form. So most of domestic company, like company operating in U.S. and producing in U.S., those domestic company, and when you distribute dividend, not only is the ordinary dividend, it's also qualified dividend. So there's different type of dividend you issue. So when you issue the dividend, you can consult with your CPA firm. Make sure that the dividend issuance is proper, because those are dictated to how tax is calculated on your 1040. So it is not just a dividend. The dividend has qualified and ordinary dividend differences as well. Of course, so there is I had one slide for you to just talk about dividend, right? So many business owners are not doing dividend distribution or dividend treatment often enough. They wait until the moment they want to close the company, then they go, oh no, I have $1 million dividend in there. I didn't know I have it. So those are the things your financial statement always presented to you that way. It's just you were not being told. So if you have a C corporation, I would invite you to look at your dividend frequently to sort out solution for it. Because a lot of times it's really difficult for for anyone to come in to resolve that in that year for you. But if you look at it very often and understand it's going to trigger taxes eventually, treat that as you go and you won't have that issue. So making sure that you don't end up in the double taxation situation. This is your own company. You should be able to just evaluate that and get that done. All right? Okay. So of course, there's also other ways to get the money out of your C Corp. So these are the way I listed, and you can pay yourself 1099 if you are providing different kind of services on your own. Then you take your 1099 to your 1040 Schedule C. Then you ended up paying taxes over there. But 1099 payment come out of C Corp is expense. Then loan from company, again, if you do loan, that's fine, it's non-taxable, but you want to make sure that you have a repayment schedule and you follow through the rate that IRS allows, so making sure that you do it properly. Reimbursement from the company, of course, that's straightforward. You can reimburse mileage, you can reimburse different things that you spend personally for the company. Of course, company paid benefit, that's huge as well, and you can literally bring in your 401k profit sharing plan, and you can also develop pension plan for your company executives or for you yourself and for your employees, however you choose, right? So those are the things can properly put away money in a separate account, not paying taxes, but allow people to take that amount when they retire or in the future and to pay taxes in the future. Like I said, the tax planning people are different from financial planner, right? We're the one that focus on present pleasures. We don't look further. We look at next year, and we don't look at the year after. So not like financial planner, they tell you 20 years, 30 years. That is just so long. Sometimes doesn't bring any feelings to the skin. It's like 20 years. I don't know what 20 years means. 20 years means a huge difference. If you just look at the 20 years before, those are the 20 years, people like me, we walk through these 20 years. The technology changes, the policy changes, and the White House residence changes. So all of these are bringing you to a new world. So don't try to predict taxes at all, because it's not worth of your time. And you just want to look at today's, no tomorrow's. And even we look at today, this is 2025, February the 25th, and it just doesn't give a clear picture yet. And we wait for a couple months to know what's going on with the new administration and figuring out the policy that they will push to the public, and so we can figure out how to arrange and plan taxes for all of our clients. And it's actually exciting years, because our firm is always known to be at the front end of interpreting what's coming through for taxes. And just like the pandemic year back in the 2020, that's when we started webinar. We started webinar on March 21st, 2020, and we were doing 4 times a week since then. So that's how many videos we have in there. That's how much knowledge we've been creating and sending out to the universe. We just hope that we help people. We help the one that wanting to handle everything themselves. This is the place that you will learn to do it yourself. All right, this is the form that I want to show you on the 1099 dividend. This is related to the C corporation, right? So C corporation, like I said, this is the second way people has to deal with. As long as you have a positive retained earning, you have to figure out whether to issue 1099 dividend or you actually use the money inside of your C corporation wisely. All right, coming back to the beginning. So this is where on our website you have that appointment button, and you will see partners here, and you can book our time and we'll come to help you. And this is our website again. Please subscribe to our website, to our YouTube channel, and we are very frequently sending out the webinar topics. If it is interest to you and you come online, if it is not, you see it later. So you'll find all of our videos right here in our channel. Our firm, we actually open 6 days a week, year round. We don't just operate during tax season. Tax season is just a filing time, but for our firm, we structure, we plan, we execute your planning strategies. So it is a year-round service. And if you make a lot of money, you do good business, but just sitting back, you go, I pay too much taxes. If that is you, you are our client. You want to visit us and get to know what can we do to help you be efficient with your taxes. Maybe you should pay taxes. Maybe you even should pay more, but we want to make sure that whatever you pay is the correct amount to pay, and it is to maximize your tax saving strategy. So, we have clients telling us that I'm happy to pay taxes. There's one client has been with me for 20 some years, and recent 3-4 years, and we were paying taxes because he did do so well. And his word is always that, Ying, I am happy to pay taxes, and I'm here already. So you can see that when people do really good business, that is not a concern. But the concern is when you grow your business, you want to use your cash wisely. And you want to give your business the efficiency it deserves so that you can go forward to become one of those people paying taxes is like nothing, right? All right, I'll see you again on Saturday, and a good afternoon again, and have a rest of Tuesday. Have a rest of good Tuesday. Bye-bye.